My goal today is twofold. Number one is I'm a big believer that everyone inside of our industry that is an active real estate agent should have real estate as part of their investment strategy and portfolio for themselves. For a couple of reasons. Number one is I think it's really hard to represent an investor and talk to them about investing in property if you're like, oh, this is absolutely what you should do. You should invest your money here, but oh, no, I don't do this myself. So that's a big piece for me, is that you should be investing in real estate yourself. I'll give some data behind why I think it's a great investment today. And so the objective and outline for today is, number one is to talk to you as investors yourself, to teach you some things about investing and how to analyze properties and how to recognize a great deal. And number two, I think it's equally important for us to learn how to have the conversations with investor clients. Because the same scripts and tools that you're using currently to help people buy and sell their own residences are great, but the scripting needs to look different when you're talking to an investor. And it becomes apparent very, very quickly to an investor whether you know what you're talking about or you don't. They know within a couple minutes. So today, as we go through this, I'm going to give you some of those specific things that you can have the conversation around that are different from your normal conversations with buyers and sellers as we go through this. So if we accomplish both those things today, oh, and I guess the last piece of this is I'm going to give you all a free investment software today that I actually created. I'm not going to tell you it's the best software in the world out there, but the reason I created it is with my investment company, Green Holdings, I was writing over 100 offers a week on investment properties and trying to pick up as many as I could, and I was taking too much time analyzing properties. So I had to create a very specific set of rules for myself that gave me either a green light or a red light instantly. And I couldn't find a property management software out there that wasn't overly complicated and answering too many questions and going too deep. I couldn't analyze properties fast enough. So I created this software that I'll give you guys and show you guys how to use it today. That I could quickly, within a few minutes, look at the 5 key indicators that were the most important to me that could tell me instantly whether I was willing to move forward with a deal or if I had to move on. So we'll cover all that. Is there anything outside of that you think specific or important to talk about? Awesome.
Sounds good.
Sounds good? Good. And then, as always, for those of you that come to my class, yes?
Marcus, I do want to mention something because I do invest.
Yep.
But what I'm finding is the ones that I look at that are good deals and I get in on, they're going for $20,000 over asking price. And then I say, man, I'm not making it. So I want to know, in this market, how can we tell a good deal?
Awesome.
Because I'm losing them and I think I can't go higher than they're getting on these.
Great point. So we're going to go into detail on that, because part of our problem is in less us than our clients is investors today. Their anticipation or expectation is they want to buy the deals of yesterday, right?
Right.
They see a house on the market and they pull it
And
up.
they
And
don't
like,
want to
oh,
compete.
someone
They don't
bought this
wanna
for this same house for $60,000 less. I want it for that price.
Yeah.
Right.
Right.
So we have to know what the deals are in our current market, not necessarily what the deals were in another market.
Right.
So the process we'll go through today will teach you how to, number one, will understand what the market is, because you can't recognize an investment or an opportunity in a market if you don't understand the market, right? Because there always is an opportunity. In every single market there is an opportunity. The key is being able to recognize the opportunity in that market, okay? So we're going to start through this process here. If anyone sees me set this down somewhere, help me keep track of it, because I lose these things all the time. So we're going to start rolling through this. We're going to start super simple. Bear with me, because I think we have to lay the foundation for this conversation. But let's start with the most simplest piece of investing. If you had to describe it, what it means to invest in 1 or 2 sentences, what would it be?
Putting your money to work, or other people's money to work.
Awesome. So putting money to work, meaning that money is going to go out and it's going to bring something back with it, right? Some of its friends. I mean, the simplest way I tell this to my kids is I actually pull my wallet out for my kids, and I have a bunch of $1 bills in there. Well, I shouldn't say $1 bills. That makes it sound like I'm doing something. $1 bills. I have small bills in there for the lesson, and I tell them, hey, my expectation is is with this money, I have a couple opportunities. Number one is I could go to the mall because I have a 13-year-old daughter within walking distance of a mall. Do you think she spends a lot of time at the mall?
Mhm.
Man alive, it's crazy. But I need to help her understand every dollar that goes into her wallet or my wallet or any of our wallets, the opportunity is number one is we can go buy something with it, right? We can go buy something that we need, and some of that money should go to putting food on the table. That's my obligation to my kids, right? They need to eat. So some of that money has to go to things we need, but some of that money actually could go to work. And the way I illustrated to my kids is I said, see these dollar bills here are gonna go to paying off the house and our food, but these ones here, my expectation is they become my employees. And my kids are you know, if they get old enough, we have that conversation, they're like, well, what do you mean by that? And I said, my expectation is I'm gonna send them out to work, and I don't want them to come back until they bring some of their friends with me. And depending on where I send them to work, they have a higher probability of bringing some friends back with me, right? James?
I mean, and this is important for everything we do. It's time, effort, and resources for a projected positive return. Because, I gotta invest all my time learning the real estate market to be an effective real estate agent, right? So that's not money per se, that's just time, effort. So it's all three of those things for what's anticipated as a positive return.
Awesome, love that. And I think that's a critical point, which is part of the reason I included the full definition here, is because we naturally just think investing is a dollar out and a dollar back, but it really goes deeper than that into our time, our energy, and we have an opportunity to increase our investment potential or our earning potential by saying, hey, maybe I don't have, for instance, I don't have the money to invest today, but I can increase my skill in investing today, which makes me more valuable to other people, okay? And we'll talk a little bit more about that. If you look over here at this little orange box, one of the interesting things, I love words and I love roots of words, where they come from, the origin of words. And the word invest actually comes from the word vestir, which is a Latin root, but it means to dress or to clothe. And a lot of times, historically, they'd use it as kind of almost like a robing of royalty, right? Like giving power to someone. Like you think of a vestibule or something that a royalty carried around, and that was in essence giving them power, right? That was a symbol of power. And to me, that is how I'd like you to view the word invest, is it actually empowers you to do things if you're able to invest your money to protect your future. It's not necessarily about just the earning the money and having the money. It's what the money can do for you, your family, and your future goals. So we talked through this enough that we all know the basic meaning of invest, but I want you to think of investing that way. What does it empower you to do if you're able to invest? And I think one of the reasons this is most critical for this group as real estate agents is the majority of us are not contributing to the company's 401k, or they're not automatically making those contributions for us. We have to take our own retirement and future into our own hands, and by setting up specific rules. It empowers us because we have more discretion and more opportunity to choose how that money's invested. However, the majority of agents don't have an exit strategy. They're not investing. They're spending everything they're making and getting to the age of 55 or 60 or whatever that number is and saying, oh, I want to retire, but I didn't put anything aside, right? And this gives you the power to do that. So let's quickly touch on a couple investment vehicles. Yes, we are going to talk about real estate investing for the majority of the time, but I think it's important to understand what are all the investment vehicles. So what are some other investment vehicles out there?
Mutual funds.
Okay, mutual funds. Okay, that's generally one that people go to a lot. What else?
Stock market.
Stock market, so stocks and bonds. What else do we see? Treasury bills, jewelry, gold, silver, right? There's a new one that's really hot and all over the place right now. Cryptocurrency, right? Now, it's funny, we could split up the room and a lot of people would say, oh, that's crazy, I would never invest in that. And other people are like, I'm making great money in it, right? So it is an investment vehicle. It's an opportunity to send money out and an opportunity for money to come back. But every time you send money out, there's also an opportunity that money's not going to come back, right? So we'll look at that. So the key with this is understanding what are the different investment vehicles, and then saying, based on my goals, my investment goals, and my perception of risk, what is the best investment vehicle for me? Now, the good news is we don't have to say, I choose one and I commit to this one for the rest of my life and only this one. Is we can say, oh, I'm gonna have a portion of my portfolio in stocks and bonds, and I'm gonna have a portion of it in gold, and I'm gonna have a portion of it in real estate, whatever you choose to put it in. However, it really ties back to what your long-term goals are, how much money you have to invest, how much time you have to get that money back, and what your risk tolerance is, which we'll talk a little bit more today about that. So the question becomes, which investment vehicle is the best? And it really depends on the goal of the investor. So let's slow down on this point for a minute. So how many of you, we just got done, you know, we're first month done in 2018. How many of you are on track for your real estate goals for 2018 so far? Some hands go up, that's awesome. Lots of hands go up. That means you should be out working right now. What are you doing in this class? No, that's awesome. So we're already 1 month in. We have real estate goals. All of us sat down. We put together how much money we do want to make this year. How many homes do we want to sell this year? But how many of you, as part of your goal process, actually put together your investment goals for 2018? Okay, awesome. Great job, some of you. So one of the things that I think is really critical, particularly for agents in our world, is we absolutely should have goals set around GCI, gross commission income. However, the most successful people I know, particularly that have come from the real estate world, think beyond GCI. They're thinking to net income first, so it goes from gross commission income to net income, how much money actually stays in my pocket, and then they actually go a step further to say, what are my goals around net worth? Okay, not enough of us are thinking about net worth. One of the best advice that I ever got when I was about 21 years old from one of my mentors was telling me that I absolutely should be tracking my net worth on a monthly basis. And I was like, net worth? I don't have any worth. I mean, I have a worth as a person, but as far as money goes, it's not a fun number to look at. But if you're not looking at it and tracking it, you're not going to directly impact it. So at 21, I started tracking my net worth. And in fact, we'll send around a sign-up sheet here in a minute. And anybody that wants it, I'll send you out a tool that I recommend using to track your net worth. But I started a spreadsheet where I actually started tracking my net worth every single month, and I graphed it. And I'm going to tell you, I'm not a crier. Like, I can sit through the notebook and not shed a tear. However, whenever I would look at my net worth at the end of every month, I was just like, oh, this hurts. This is not fun. I was a 21-year-old kid wanting to invest, didn't have 2 pennies to rub together, right? But the idea behind it is that pain every single month of looking at it fired me up to say, hey, when that check comes in, I'm not going to do what all my friends are doing and go and buying a brand new car or a Rolex or whatever it was. Is I already had predetermined, because my goals were more important to me, where that money was going to go in preparation for me to invest in building an investment company. Okay. So you have to know, number one, what are your investment goals? And I'd encourage all of you to have a net worth goal. How are you going to directly impact your net worth this year? And the other piece of that is really critical, that I set a goal around every single year, is how much of my income is going to come from passive income versus active income. Now, active income is you're out showing homes, you're out going on listing presentations, your efforts are generating that income, and that is active income. Passive income is also sometimes called mailbox money, right? What income is going to come to you regardless of whether you're working or not? And we need to have a clear understanding of what portion of our income is coming passively versus actively, and understand what is our goal, ultimate goal of passive income per year, and how am I directly going to impact that this year, okay? Second comment I'll make about this is, as a real estate agent, too quickly we think we understand or want to assume what the goals of our investor clients are, and sometimes our investor clients don't understand what their own goals are. We need to get good at having the conversation about helping them understand what their goals are, so that we can provide them with opportunities that match up and are in alignment with their goal, okay? So a couple things to consider here with this are asset allocation. So what do you think I mean by asset allocation?
How the money will be distributed.
Okay, how it's going to be split up, right? For a great example of this is my 13-year-old daughter now is an investor. She invests with me, which is a lot of fun. But she doesn't have, she's a babysitter. She doesn't have enough money to go buy her own investment property, right? So we've talked about what are the best investment vehicles for the amount of money she has. Even though the returns might not be as high, they're more safe, but they're going to help her build to where she can do bigger and more investing. So we look at asset allocation. So part of the conversation, number one, with yourself and with your investor clients is, what is your current asset allocation. How much money do you have sitting in the bank making less than 0.15% or whatever it is now? How much money do you have in the stock market? How much money do you have in real estate? Like, get a feel for what your asset allocation looks like and ask yourself if it's a healthy allocation based on your goals. Now, a great example of this to give you an idea is, if here I am, I'm 37 years old. Don't anyone say anything about my gray hair. 37 years old, I look at that, and with my asset allocation, I'm comfortable saying that a smaller portion of my portfolio is in very, very safe investments. Things like mutual funds, or even some of the stocks that I invest in are more safe returns, right? Sure things. A bigger portion of my portfolio is actually more aggressive and a little bit more at risk. However, my demand on that money is they're going to bring back more friends, right? So that portfolio structure may look different for me when I'm 50 years old, right? Because at that point, I'm going to be even more heavily into wealth preservation than wealth accumulation mode, right? So right now, even from the time I was early 20s till now, I've already shifted a portion of my portfolio over to wealth preservation. But a good chunk of my portfolio is still very aggressive, because even though I'm 37, and if you talk to the guys on my real estate team in Arizona, they call me the old man because they're all in their early 20s, and I don't feel very old. But I know that tomorrow, if I lost everything, I could go out and earn it all back, right? So I have that confidence. I don't want to lose it all, and I'm not gonna, and I'll show you that I'm actually a very conservative investor. However, I know that right now it's okay for me to be more aggressive in my asset allocation because of my timing and my age, okay? Required rate of return. So we need to understand, what is our required rate of return? So I look at the money in the bank making 0.25%. Am I okay with that? No, it's not even keeping up with inflation, but what is my required rate of return? So I'm gonna start establishing. The question goes to your investor folks that you're working with is, help me understand, what is your required rate of return? Who's got some investor clients they're working with right now? A couple people. Are your investors, are the majority of your investors very realistic on what returns are available in today's market? Some of them are, some of them are way off the mark, right? Because they're showing up late to the game, where they're hearing about the people that were buying homes in 2011, 2012 and made a bunch of money, and their expectation is, I want to make those same type of returns. Now I want into the game, right? Now that I see a bunch of people that have done it. So we need to get a clarity on what is their required rate of return. And two things come to mind there. Is number one, we either need to decide, can I get them in line with reality? Because if I can't get them in line with reality, it's not worth my time. We talked about a time investment. It's not worth me investing time in this relationship if I can't get them in line with reality, okay? So we'll talk a little bit more about that. Risk assessment is, and we do a lot of investor transactions, both for our own investment company and working with investors because of our track record. But a lot of times what people will say is they're ready to take on the risk, when in fact they're not ready to take on the risk, right? They watch enough HGTV that they want to be a real estate investor, but when it comes down to putting the money down or ink on paper, they're like, whoa, wait, what? I have to do what? And they make it look so easy in that 30-minute show on HGTV, right? So we really need to go a little bit deeper with risk assessment to ask them, like, this is what it means for you, and asking questions like, okay, so if you put $40,000 down on this property or $30,000 down on this property, and it's going to take an additional $25,000 of renovations to get it ready to rent or flip, what does that do for your finances at home? Well, I'm going to max out all my credit cards, and I'm going to mortgage off my kids to my neighbor who really wants a kid, or whatever it is. If they start talking like that, is that a red flag for us? Right? We need to know how to have the conversations, go a little bit deeper with risk assessment. Timing. Why is time important?
Time's everything.
Time is critical, right?
Buy the dip.
What's that?
Just kidding. Buy the dip.
Oh. So timing is important for you to understand hey, is this person's expectation, or is my expectation that I'm going to have all my money back within 6 months or 12 months, right? Or is it critical that I have this money back in 12 months because I'm sending my kid off to college and I want to pay cash for college, right? Or whatever it is. We need to understand what the timing, our own timing goal is, when we need the money back, and what the timing is of our investor clients if we're working with them. And then the last one is, I think even if we get good at conversations 1 through 4, a lot of us avoid conversation number 5 here, which is asking ourselves the question, what are the other opportunities? Because there are so many opportunities out there, particularly in a market like this where there's a lot of money circulating. Is I can't tell you how many calls I get a week of people asking me to invest in different things with them. And they all could make money. They all could be opportunities. But I need to be asking myself, where is the highest probability that my money's gonna bring back money that fills these guidelines for me, and I feel like have the least amount of risk for a dollar coming back. So number 1, having the conversation with yourself is important. But number 2, learning to have the conversation with your clients a lot of times is hard because we're talking ourselves out of a commission, getting a commission. So we need to be asking our investor clients of saying, hey, I'm absolutely the person to help you. I understand real estate investing. But real quickly, let's take 5 minutes to talk about what are the other opportunities for money if you chose not to invest in real estate today. And it circles them away from them hiring you to help them with the real estate transaction. However, it's going to do one of 2 things. It's going to bring all of their concerns to the surface of saying, hey, no, I've already looked at that, or my portfolio is already full on that side. I am ready to make a real estate investment. Or it's going to get them to say, oh, no, I absolutely, I'm not ready to make this risk. I'd rather do this other investment, maybe a little bit less, but I'm going to go down this route, right? So we need to look at what the other opportunities are, both for ourselves and for our clients, and ask ourselves the question is like, hey, is this the best opportunity for my money today? Okay? So while there's a lot of investment vehicles, I obviously am a little bit biased. I truly feel like real estate is the best investment out there. Not to discount any of the others, I do have a portion of my investment portfolio and some other things, but the majority of my personal investment portfolio is in real estate. And the truth of the matter is, if you go back in history all the way till even the Mayan people, is 90% of the world's millionaires in every era really were created by investing and dominating real estate. Okay, so there's some truth to that history. So let's jump into this a little bit as far as benefits offered by investing in real estate. So the rest of our conversation is really going to be focused on real estate specifically. So let's look at these different opportunities or different benefits. Number 1 is rental income. So all the time investing in real estate does not necessarily mean we're going to go out and rent it and generate passive income. Sometimes investing in real estate is flipping or something like that as well. But generally speaking, there's an opportunity for rental income. I will tell you that when I'm looking at a potential flip property, something I'm going to buy and turn around and sell, is I'm a big believer in exit strategy. So even if my intention is to buy a property to renovate and sell, I've got to have complete confidence that I can turn around and easily rent it, still for a return as my exit strategy. And I'll tell you that one of my flaws is I fall in love with my projects. So I can tell you how many times I've bought a property to flip it and then fell in love with it and I just ended up turning it into a rental property anyway to hold on to it. Appreciation. So why is appreciation a benefit offered in investing in real estate?
It's like stock. I mean, it appreciates.
Okay, awesome. So it's like stock. The value of it can go up, right? So for instance, if I went and bought, took $100,000 out of the bank and I went and stuck it in a safe at my house and waited a year and brought it back out, does the value of that $100,000 change significantly? Not really, right? But if I take that $100,000 and go out and put it into buy a piece of property that's worth $100,000 based on where our market is going, then I actually have about $109,000, right? So I'm increasing my net worth more than my investment going in. Okay, leverage. Why is leverage important for real estate?
Leveraging the banks.
Okay, other people's money, right?
You can do more with less, yeah.
Yeah, it's really hard for me to go down to the bank today and say, hey bank, you know, I've got some money here. My plan is I'm gonna go buy $250,000 worth of gold bars this afternoon, and I only wanna put 20% down, but you guys loan me the other 80%, right? There's some lending opportunities out there for that, but it's a challenge for most people to go get that type of loan, right? And so the leverage opportunity is huge because where now I could go look at a property for $150,000 where anything else, $150,000 worth of gold is going to cost me $150,000 of cash, where $150,000 of a house could potentially only cost me $20,000 to $30,000, and I could use the rest of that money to go do 2 or 3 more of those houses because I'm able to leverage it. Right, particularly right now, is money expensive or cheap?
Cheap.
Money is cheap. I'm a big believer, this is my philosophy, is I'm a big believer that we'll never see money this cheap again in our lifetime. Right, so even for a lot of the properties that I either cashed out or I have the ability to cash out, I'm choosing leverage because I know the direction that interest rates have to go, and I want to lock in a rate and make my money as cheap as possible, okay? Which goes back to this point too, because what happens when money becomes more expensive and my payment stays the same, do rents go up or go down?
Up.
Rents go up too, right? Once appreciation kicks in, interest rates are gonna go up, but also rents are gonna go up. But if I'm locked in at a good rate, my spread or my return increases as that appreciation happens. Okay, why would I have depreciation and depreciation both on benefits list?
When I get depreciation on the structure.
Taxes.
Okay, so I have the opportunity from a tax perspective to now depreciate some of my income, right? So now, to me, this is a critical piece, is I see too many people getting to their first real estate investment, and they're like, they're paying for the plumber to go out of their personal account, and they're putting the rent income into their personal account. This is an actual business, and you have to run it like a business and track it like a business for you to really maximize your opportunity with depreciation. And this is something that is the law, that you have to depreciate, but if you strategically track it, you have an opportunity to really maximize that opportunity to depreciate those expenses associated with owning investment property, right? And depreciate the value of the asset over a specific amount of time. Which leads into the last one, business expenses. So for those of you that have real estate already, ask yourself the question, is there a clear distinction of my personal finances and my investment finances? And can I track that? And if the IRS came in today and questioned my depreciation, could I say, hey, no, here is my specific profit and loss statement specific to this property, okay? And I'll talk a little bit more deep about that as we talk about how to vest a property or how to own a property for risk mitigation. Has anyone here read the book, The Richest Man in Babylon?
I thought of it when you said that
Oh.
your children making children. and
Awesome.
people, yeah.
It was the first business book I ever read. My grandpa Lou Nord.
I give it away as wedding gifts to everybody.
Oh, do you?
Sorry.
I love it.
It'll change your life.
It's the first business book I had my daughter read a couple years ago. In fact, I think some of you may have seen it. We did a Facebook Live conversation just to get her perspective on it, which was a lot of fun. She's actually, speaking of her, she's actually getting her first big return on an investment this week. I'm so excited about it. It's gonna be fun. So How to Speak Investor is a great short little book. I highly recommend you read it. It's written in story format, so it's a little cheesy in some ways, but the principles are really phenomenal and really good. By the way, I'll post for any picture. I'll send out the slides. We'll send it around to, is anyone in my team in here? Eric, would you mind in a minute grabbing, Rachel, will you grab a piece of paper we can pass around for email addresses? Awesome, thanks. So the name of the book is Richest Man in Babylon, and I'm just going to quickly touch on a couple of them because it really the whole point of the premise behind this book is, hey, create rules around your money so that you can determine and drive your profitability and your income goals. So it says little things like, hey, save 10% of all you earn, right? It's a simple goal. We hear that from Dave Ramsey as well. Learn to live on 90% or less of your income. And a lot of these are principles you learn to live on when your income's low, but you can shift these percentages over time. Or as you increase your income earning potential, now we live on less than 30% of our income, and now we have over 70% of our income that is strategically being placed and sent out to play to bring friends back out with it, right? Invest your accumulated capital into projects that will provide a safe, steady income. Take full advantage of compounding interest. We talked about that. Number 4, which is actually, this is one that I want to talk about and sit on for a minute, because to me this is really critical to this conversation, is number 4, invest only in areas in which you have expertise or with people who are experienced. This is, I see this all the time, really phenomenal real estate agents that do a lot of business. They mess up on real estate investing because they aren't thinking from an investor mentality on a regular basis. They're not an expert in the investment world. The trick with this is no matter how often you're selling homes, you cannot recognize a great deal or a needle in a haystack if you're not consistently looking at deals on a regular basis, because the consistency of the action is where you're finally going to say, oh, out of these 100 things I've looked at, this one looks different. If you look at just one periodically, you don't have anything to compare it to say it's a good deal or it's not. And I'll go a little bit deeper on that. So this is also critical. Number one, if you're planning on being a real estate investor, an active investor, become an expert. Time block some of your time specific to becoming an expert. And number two is we have a monster opportunity to help other people become real estate investors that don't want to spend the time analyzing properties and learning investment on their own. A great example of this is when I launched my investment company, is I still was able to buy a couple, I had generate enough income that I could start investing my own money, but I didn't have enough money to invest as fast as I wanted to invest, but I could absolutely bring the expertise to the table. So I immediately went out and made relationships with people that were the best of the best in their field, but they did not have the time to go out and learn how to become a great real estate investor. So I started targeting people like lawyers, doctors, small business owners, people that I knew had extra income, that they were just sticking into the stock market, but they were complaining every day about what was going on in the stock market. And I could go meet with them and have a conversation to say, hey, I have opportunities, here's my track record, I would like to help you invest in real estate, and not only am I going to represent you on the transaction, but I actually want to partner with you on the project. So a lot of the opportunities we created went beyond just saying I'm going to represent you as a real estate agent, but I created partners with them. And now the fun thing is if you do that enough times and you bring back money to them and their money went out and came back and they saw that it's directly related to your activities, now you create a circle of people that anytime I get a new deal now, I've got my list of people. All I do is call and be like, hey, it's Green, I got another deal, you got money available? And they say, their normal response is, yeah, I'm in. What's the deal? Not the other way around of, what's the deal? I'm in. Yeah.
Just a quick question, for a deal like that, if you go to someone, what would you generally do? Let's say it's a flip. Let's say you found flips at, hey, I've got a flip. What would be the structure you do on something like that? Just in a general sense, or what someone could present if we want to do the same thing? Would you say,
yeah,
50-50, you bring cash, I'll manage the project, I'll help you buy it, sell it, and
yeah,
we do it that way?
Yeah, so very similar to that. Now, it always depends on the relationship with the person, right? So for instance, when I was in my early 20s or late 20s, by the time I started structuring it this way, is a lot of times I was connecting with someone that I did not already have a relationship with, but I knew I wanted a long-term relationship with them. So I would present it to say, hey, normally I do a 50-50 split on this, where I do all the equity, I put the deal together. You don't have to worry about a thing, and I get 50% of it. But because I want to build a long-term relationship with you, I'm going to do this one at 20% so I can show you what we do, really push your income on this one with the anticipation that you're going to be so happy with it that we're going to roll into the next one.
Cool.
Okay? So a lot of times, depending on the person, I would do it that way to build the momentum. And now it's just the expectation that, hey, and a lot of times I still put skin in the game to even increase my potential. And now I very rarely will ever get into a deal that I don't 100% control. So I at least want 51% of the deal. So a lot of the times I'll work it in to say, hey, I get 30% of the income based off of me creating the deal and carrying it through to the end. And I'm also going to put in X amount of money for the other 21%. So I'm going to be 51% owner of the deal. Okay? Yeah.
How much money is the average investor putting out of pocket in these deals for you?
So that's a good question. So one of the primary ways I've done a lot of deals like this is I go build relationships with these people that have significant amount of money sitting somewhere that they're not happy with their returns, right? So my ideal scenario, because at some point I got capped with the banks of how much money I could borrow because I wanted to leverage everything I could. And so I would work a deal with them where I'd say, hey, let's do this deal together. I'm going to create a new entity, a new company, where I own 51% of it, you own 49% of it, and I'm going to put in 51% of the cash, you're going to put in 49% of the cash. So in the actual entity, we were equals in our skin in the game.
So they're putting in all the cash, they're not lending in, or they're not borrowing any hard money.
So the second piece of this equation with a lot of these guys is what I'd say is, hey, and the second piece of this deal is now you're going to make a personal loan to the new entity, because that gives them the safe piece of it that they're going to make 4 to 6% on a standard mortgage to give them the safety piece, and now they get 49% of the actual profits of the deal as an owner of the deal. So they're getting two pieces of the deal, but they're leveraging it. And a lot of times they do a 90% loan to value on the property where we'd only come in with 10% of the cash. right? Well, that's really hard to get from an investment standpoint, going to the bank.
Well, and borrowing it at 45%.
Brandon, was there a comment?
I'm just commending that, that's beautiful.
Yeah, so
Good setup.
the thing I loved about it is a huge win-win for them, because they were, even at the 4 to 6% on the loan, they're making more than they consistently were in their other investments, either in the bank or the mutual funds, right? So they were excited about the safety of that, and they were excited about the big check that came with the other piece, okay? Did that answer your question, Greg?
Yeah, and you would pay them, I just missed that last part, you pay them also 4 to 6%?
So
for
that,
their money?
that entity, so they would actually be paying themselves 2 interest, because our new entity that we were partners in, we would just be making a mortgage payment back, right? And a lot of times I'd set it up as like an interest-only payment, so it wasn't interest plus principal, the payments were really low, but they were just getting the interest payments every month, right?
Okay.
He's
So
saying
some,
the 41% of his 51, they'd give him the money for that.
yeah.
And he'd give him the 4 to 6% mortgage rate, and 90% LTV,
Exactly.
whatever, you know, so.
Yeah, and they love it. It's a great deal for them because
They're not hard money lenders, these are people.
yeah, exactly. Yeah, this is not. I occasionally do hard money, like we'll borrow hard money. I personally am not a huge fan of hard money. I understand that earlier on, sometimes to get deals rolling, you have to do hard money. But I'm in a position now where I'm actually on the other side of the equation where I do the hard money loans because I just don't like the terms on it. Okay?
What are your terms?
Depends on the project. I actually do some really, I laugh at the kind of loans I've been doing lately. They're like way outside the box, but the return, like I got a 60% return on a loan I made the other day that was so awesome. And it was a win-win. That's the key, win-win for everybody. Okay, let's keep moving here. A couple other principles it talks about in the book is make sure you're buying your house. It doesn't suggest renting. Obviously, there's some scenarios in which it makes sense to rent if you're going into a new area or whatever. But normally speaking, that should be your number one investment. If you don't already have investments, is you should look at your primary residence as an investment property. Okay, whether to eventually turn it into a rental property or to build the equity in it, turn around and sell it and go do the next property. Okay, have insurance, but don't get taken to the cleaners with insurance. We'll talk a little bit about that. And then always keep working at various ways of increasing your income. To me, this is something we miss all the time, is your number one way to increase your return on investment is strategically saying, do I have a personal growth plan in place that I can increase my earning potential? Because that's essentially your safest investment ever, because it takes really very little to no money out, but then it's yours to own forever. Nobody can take it away if you increase your knowledge of how to increase your earning potential, okay? So for those of you who don't have personal growth plans in place, I consider that part of my investment strategy. Okay, so we're gonna cover 2 vocabulary lists today, and I know that sounds incredibly boring because it sounds like school, but there's really 2 approaches to investing. I have investments in multiple markets right now, and I always want to start from a very macro level. I want to look at it from a really high level to say, what is the overall health of this market? If I'm going to put money very small in a very small one piece of property in this city, I want to make sure that the overall trajectory or the direction of that city, the health of it is good before I decide to go local there. So vocabulary list number 1 is we're going to talk about affordability, population growth, unemployment rate, and inventory. Okay, so we're going to talk on each one of those real briefly. So housing affordability index. Who can give me a quick definition of affordability?
Median house value, median income.
Perfect, right? So it's taking about 30% of the median income and saying that is exactly what it would take to pay for a mortgage payment at the current interest rates, right? So that would be an exact affordability of about 100. Anything in excess of that would mean that after I take 30% of my income and make my payment, I have some money left. Anything below 100 would mean I took 30% of my income, went to make my mortgage payment, and said, oh boy, I don't have enough, okay? So that's how they track affordability of a market. So Utah, the affordability index in Utah is currently around 116, according to the Utah Association of Realtors. But the National Association of Realtors actually shows our statistic a little bit higher, but UAR shows it at 116. So looking at that, is that affordable or unaffordable? Okay, it's affordable because it's in excess of 100, right? So this is where a lot of investors are getting caught up right now, is because our affordability index in 2012 was what?
160.
About 167, 169, right? And so this is going to be an issue that we deal with for the next decade, because a lot of the investors that we're working with are now getting into their professional years where they now have disposable income to invest. But the only market they've ever lived through was the market of 2007 to now, right? They saw that huge swing down, a correction of our market, and that is the market they know. So their expectation is, oh, this affordability isn't good because it was 167, right? Now, could we see it go back to 160, 150 again in our lifetime?
Yes.
We could. Is it likely? I'm even if, from my perspective, I'm saying probably I'm going to be in major wealth preservation mode by the time that happens again. Okay, because yes, our market goes through cycles, but that wasn't a normal cycle. That was a major cycle. Okay, so we need to look at this and say, hey, okay, right now our market is still affordable. There's still opportunity in our market. Now, are some things overpriced?
Yes.
Is everything overpriced? No. And then, is it okay to pay a fair market value for a piece of property if all the other indicators in that city are positive? Yeah, right? Let's talk about, we'll touch base on those as we go through this. I like to look at, as a lot of you know, I do a lot of investing in Arizona as well, so I pull both statistics at the same time, and it's interesting to look at what the neighboring market's doing. Arizona's affordability is still at 125. US, the affordability is at 149.
Wow.
Okay? Now, what does that, from an investor standpoint, what does that make you think?
Ours is going up. Ours is gonna go up.
Okay, ours could potentially go up, or what else could it mean?
Ours could go down.
Okay, some people would be like, oh, well, I'll go invest in another state, right? So the key with every one of these pieces of vocabulary is one conversation is not enough to have on its own. It's how they relate to each other. So for example, up in the Midwest right now, the affordability is way higher than 149, right? Why?
Because they're all leaving.
They're all leaving. Their net migration is crazy. People are leaving, crime is way up, and values are way low, right? So does that make it a great investment because it's affordable? No. Okay? So the key here is let's get clarity on what are the key conversations to have and how do they relate to each other. Because if unemployment is needed, that should throw a major red flag. So it's not just an affordability conversation, but I want to make sure a market is affordable and what is the direction of the market. Okay? Something interesting here to look at, if you look down at this area here, it breaks down the affordability. This is from the National Association of Realtors, the affordability by geographical areas, Northeast, Midwest, Southwest. And if you look over here, like the Northeast is at 171, down to the West is at 112, okay? Population growth. So why am I interested in population growth?
It creates.
Okay, supply and demand. If more people are coming here, more houses are needed, right? If more houses are needed, we might not be able to, we're having this problem right now, we can't build fast enough for how many homes we need, which does what to the existing inventory? The prices go up, right? So if our population projection is to be at 5.5 million people by 2065, those are great projections from a population standpoint, both from new construction and from existing inventory, right? There's a very high likelihood, unless the state of Utah does something majorly wrong and all these businesses that are coming here start leaving, there's a great chance that the value of our assets are going to be protected. Arizona, same thing. They're currently at 7 million. They're projected to be at 13.1 million by 2050, so even at a faster rate. So Utah and Arizona are two of the fastest growing states in the country right now. Unemployment rate. Why is this important?
Oh, drives the capacity to be able to afford.
If people aren't working, they're not making money. If they're not making money,
Gotta have borrowers.
You can't buy a house.
you either got to rent or be a borrower, right, to drive an economy. People have to have money to spend. So unemployment rate's really critical to watch. Utah led the nation this year, as a lot of you know, coming to the market update. We created more jobs per capita than any other state out there. Actually, we're tied with Nevada, the two fastest growing states in creating jobs. Our unemployment rate is at 3.3. Arizona's unemployment rate is at 4.5. And the nation is 4.1. Okay, now remember when we first started at the beginning of this, I said it's critical to create rules. And if the rule passes, it's green, and if the rule doesn't pass, it's red. When it's red, does that mean I automatically shut it down? It makes me do what?
rethink it.
Makes me ask the question, why? Okay? So a great example of this is right here. I want to invest in areas where the unemployment rate is outpacing the national average, right? So here I am, I'm launching 2 brand new developments in Arizona right now as we speak, yet the unemployment rate in Arizona is 4.5, but on the national it's 4.1. So if I clearly created the rule and said that was red, I would shut those developments down. Why would I break that rule?
It's still so low.
This is from the working force, so people working age. Great question.
Well, but in Arizona, you have a lot of snowbirds. So would that be a reason to question that
Good
rule?
point.
So that's a great point. However, actually in the last 10 years, that has way less of an impact in Arizona than it used to, because the median age in Arizona is actually now 37. Yeah, which it used to be much, much higher. So I like that you're thinking that way though, because that's the exact example of why, right? We want to say, well, why would it be that way? And in this instance, I look at this saying, because Arizona's so big, there's 7 million people in the state, there's several million just in Phoenix, people are coming in so fast that they can't quite create the jobs fast enough for the people, right? So they're working at driving in more people. So I'm not overly worried. If that was a bigger gap, I'd have a bigger concern, but they're just playing catch up to the growth, okay? But again, the point I'm trying to make there is, if it doesn't fall into exact line, the question is, why? Can I explain why this is happening to a point that I get comfortable? The only deal I've ever lost money on in my whole career from an investment standpoint is because I broke the rule and I created a false story around it because I fell in love with the deal. And I'll tell you what, going into a bank and writing a check for $100,000 is an education you never forget to get out of a deal, and you only do it once and you never break your rules again, okay? So create your rules, live by your rules. If you're ever going to break a rule, get very clear on why and be able to really clearly justify it without letting emotions make the decision. Okay, inventory. So inventory really is about just becoming an expert in your area. It's really hard to find a needle in a haystack from the outside looking in, being like, there's a needle in there somewhere and it's gonna automatically surface by itself. You've got to get your hands dirty, you got to go in and systematically approach it and look for that needle. And that's really, particularly in a market where affordability is like under 120, is now saying, we know that every house is not a deal, but there are good deals out there. We just know how to find them and look enough that we find them, okay? So no supply of inventory by the area, pricing trends, building permits, new builds, etc. We talked at length about that at the quarterly market update, so I'm not going to go into detail on that. But just the whole point with this is know your inventory, be an expert of the areas in which you're investing. And if you're not an expert, hire an expert. Okay? Vocabulary list number 2. So vocabulary list number 1 is from a purely macro level of saying what is the overall health of the market. Vocabulary list number 2 is going more on a micro level of saying, okay, I'm comfortable with the market now. Let me pick the specific investments inside this market and how do I analyze them? So there are 100 ratios. Any other business finance majors out there? There are a billion ratios that you could look at and you could get lost in statistics forever. From my perspective, these are the most critical things to look at on any property. And again, the same conversation goes that it's not only one of them matters. It's how they interrelate with each other. And then the type of investment, I may give more weight to one than the other. So the first one is debt coverage ratio. Second is annual gross rent multiplier. Third is cap rate, cash on cash return. And the last one is called effective return on investment. And I'll give you the definition on all of these. Now, based on that list, which is the one we hear most thrown around in the real estate world?
Cap rate.
Cap rate, right? Now, cap rate has an absolute place in what we talk about in the real estate world. However, in my opinion, we use it way wrong in our industry because people want to live and die by a cap rate without understanding how it relates to these other pieces, okay? So we'll go into a little more detail with that. So let's start with debt coverage ratio. So the debt coverage ratio is the amount of cash flow available to meet annual interest and principal payments on debt. So a debt coverage ratio equals the net operating income divided by debt and services. Okay, so a debt coverage ratio in excess of 1.0 would indicate an excess of cash after all debts are serviced, okay? So basically you're looking at this saying, okay, once I've taken the income, I've paid off the debt, is there money left over? And the greater the number above 1, the more cash that's left over. If it's under 1, means there is no cash left over. I'm actually have to infusing money back in the deal to carry it, okay? So real quickly we can look at this and just determine what is the debt coverage ratio. Is enough income coming in that I can clearly cover the debt, okay? Now, this is a quick way to analyze it. A couple things that I'll make a comment with net operating income, because a few of these statistics have to do with net operating income. A mistake that we make, particularly when we're looking at either like a commercial building or a retail building as an investment, or even a multifamily building, is we're provided as part of the due diligence period a profit and loss statement. How many people in here feel confident in reading a profit and loss statement? Okay, a good handful of you, that's awesome. So here is the trick with someone else providing you a profit and loss statement for you to analyze as part of your due diligence, is you have to ask this question. Are they operating the business the way I intend to operate the business? The greatest example of this is this. Say I'm buying a commercial building that is owner occupied by a landscape company, okay? Number one is they're managing it themselves. They're not paying any management fee. Number two is because they're a landscape company, they're maintaining the grounds and the landscaping themselves, and they're not charging for it on the profit and loss statement, right?
Okay.
So here I am, I'm buying a owner-occupied building. Even if I'm gonna rent it back to them, do you think their expectation is they wanna get paid to do the landscaping on the building now?
Yes.
So I've gotta make sure the profit and loss statement is modified for how I intend to use the property, because that's how I have to analyze the numbers. Okay? So particularly that shows up in the net operating income piece. Any questions on debt coverage ratio? Number two is annual gross rent multiplier. So annual gross rent multiplier is the number of years the property would take to pay for itself in gross received rents. It equals the annual gross rents. So it's really important with all of these equations to understand when it's saying net versus gross and understanding the difference. So gross rents is all of the income coming in from the property, okay, before anything's subtracted, divided by the purchase price. This method is particularly effective in comparing multifamily projects where expenses are assumed to be similar across the board. Okay, so like with single family homes, I still run this number out of curiosity to look at what it is, but I don't put as much weight into it as I do with multifamily properties, okay? One of the reasons is if I'm buying a single family house in a neighborhood, is it pretty easy to find comparables in that neighborhood of a similar sized property?
Yes.
If I'm buying a multifamily property, say a sixplex in an area where it's not a row of a bunch of sixplexes, is it easy to find comparables to that property in the same area? So this is a great way for me to open up to a broader search and now say, hey, there's a sixplex, there's an eightplex, here's a fourplex. They're all similar in quality, in grade, whether it's an A property, B property, or C property. And I can quickly look at the annual gross rent multiplier to look at it and say, okay, are they all about the same annual gross rent multiplier and the number of years it gets to be paid off, okay? The other reason I think this is interesting is if you're in a long-term hold position, I want to get kind of a feel of like, okay, well, how many years until this becomes really a cash cow for me, right? I want to get, is this 7.5 years? In 7.5 years from now, my cash outlay is going to significantly go down, and my passive income goal is going to be more in alignment with what my long-term goal is. So that's another way I use the annual gross rent multiplier. Cap rate. So, what are cap rates right now trading for?
5, 6.
Okay, 6 and 7. Those are actually pretty high. We're seeing stuff actually
4.
a little bit lower, like 3 and 4 on cap rates right now, which is really low. But that's the reason I like that everyone knows cap rate. It's a really quick, easy way for you to ask that question. Hey, what are properties trading for? What cap rate? And everybody has a pretty close answer to what things are trading for from a cap rate perspective. Okay, so let's go a little bit deeper on this. So cap rate shows the potential rate of return on the real estate investment. The higher the cap rate, the better it is for the investor. Okay, obviously we all know that. Cap rate is a good jumping off point to quickly compare many investment opportunities, but it should not be the sole factor in any real estate investment decision. people put way too much credence on just the cap rate alone. Okay? So the cap rate, the way it's determined is you take net operating income, remember, net operating income not as it's currently being occupied, but how we intend to run the business, divided by the market value. Okay? What's the difference between market value and sales price?
Market value and sales price? Yeah, market value is what the market determines.
Okay.
Sales price is what it's sold for.
In a hot market like this, what happens to the market price versus sales price ratio? Is it closer or farther apart?
Further apart.
It's closer in this market right now because of the demand, right? There's more demand on the properties, meaning it's probably going to go closer for list price or the sales price, right? You're probably going to buy it pretty close to what the market is. When the market's really out of skew and there's more inventory on the market, and there's more to choose from, you have a better opportunity to negotiate a great deal, right? So the reason I put this in here is it's important when you're calculating your cap rate that you're actually comparing it off of the market value and not necessarily the sales price, because that's going to drive what your real cap rate is. And if you buy it at a discount, it's going to increase your cap rate by going off the market value other than the discounted sales price. Okay? So this is the way I like to use cap rate, is these two bottom bullet points here. Is number one, I like to use it just for a quick, hey, am I willing to put more time in understanding what this investment opportunity is, because it's trading in that world of where I think it should be. And if it is, then I actually use cap rate in my negotiation strategy for the project. So the cap rate can be used backwards as well to determine what price to offer. So an example, if the net operating income is $125,000 and the minimum you're willing to accept as a rate of return is a cap rate of 7.5, then you can deduct the max you are willing to pay, because your offer price now equals net operating income divided by your minimum cap rate that's acceptable to you. Okay? Now, the thing I love about this is, number one, is I pick apart the profit and loss statements to a T, because I'm going to argue that there's some additional expenses in there that they're not doing, because I'm going to try to push the income down, okay, for my intended use. Second is, instead of just going back on an offer or making an offer and being like, hey, this is what we're willing to pay, I'm going to have a deep conversation with the agent and say, hey, you understand cap rates, right? You understand the things you're trading for. Hey, what you're asking for the property just does not make sense. Let's work through this together. I'm going to walk them through my scenario here, saying, hey, look, yeah, you gave me the profit and loss statement, but in reality, like, the profit's actually going to go down by about $20,000 by the time I start covering my own landscaping and pay a maintenance company or a management company, right? And so now I'm going to take that new number divided by what my acceptable cap rate is, and just say, hey, this is what I'm willing to pay, and I'm not going off emotion here. This is what the numbers are telling me it's worth. And now that agent or that other person is going to look at it and be like, oh, they really thought through this, and there's probably some validity to what they're saying, because they're not basing it off of emotion. So that's how I use cap rate a lot, is I reverse engineer either an offer price or a renegotiation. So even if I tie a property up, and part of my due diligence period is where I get the information on the profit and loss statement, I'm going to go back and say, hey, look at this. This isn't working. Yeah?
How many times are you walking away from a property because someone else is willing to pay that? They're not going to look through that analysis and they say, look, I'm not going to go off the price $70,000 because someone else is willing to pay that. And they don't really care. I mean, so then you're getting beat out by someone that might not be getting as good of a return, but they're still beating you out, so you now don't have that opportunity.
100%. So the two things I have to already have predetermined before I walk into that conversation is, number one, am I ready to lose this deal at this price, right? And number two is, what is my absolute rule on this property? Because what I don't want to do is walk in there and have a better salesperson on the other side to be like, hey, I've got 3 other people coming in with offers tomorrow, and me to be like, oh, okay, I'll buy it. I'll buy it for whatever, right? And then I broke my rules, and then 6 months down the road, if I break my rules, there's a very good likelihood that I'm going to hate this property in a few months, right? So for me, I've got to predetermine my rules up front, and then if I get beat out 99 out of 100 times because it doesn't fall within my rules, that is okay. I can live by that. What I don't want to do is not be clear on my rules, lose out on a property, and always regret it. But if I made the decision based off my rules, I'll never regret it and just be like, the market drove it, and probably at some point that person overpaid for the property, and if the market shifts again, I might be able to go in and buy it for $50,000 less, and I'll watch it. Okay? Does that answer your question?
Yes.
The problem in this market is there's so much money available to invest, and there's so much emotion around the decision to invest, that we got to be okay losing the deal. And it becomes more, just one more point, not to beat a dead horse, but it becomes more emotionally hurtful for us if it's the only deal we're looking at, right? But if we're like, hey, no, there's other deals out there, I'm systematically looking at properties every single week where if this one didn't work out, that's okay, the next one will. Okay, cash on cash return. To me, generally speaking, this is the most important because of the analogy of every dollar that goes out, I want to make sure it's bringing in some dollars back with it, right? And that's exactly what this indicates. All the cash that goes out should be bringing money back with it. So cash on cash return is a ratio based on the annual cash flow divided by the equity you have invested in the property. The cash on cash return is calculated by annual before tax cash flow divided by the total cash invested. This is where leverage really pays off because I can buy an asset worth $200,000 for $40,000 or $30,000 out of pocket depending on how I structure it. But I'm going to get, they're going to rent the full $200,000 asset from me at the $200,000 price, right? So this is where I can really look at how much money is really coming back to me on this investment. So cash on cash return is the one I put the most credence on. So this is the one where the rules you create for yourself, I keep harking on not bending your rules, but there's times where you need to change your rules, okay? But you gotta really understand why you're changing rules. A great example of this is all the dozens and dozens of houses I bought down in Arizona as personal investments. Is I was only buying things that offered me over an 18% cash on cash return on the properties. Now in retrospect, I look back at it now and I'd make an offer on a property and the bank would come back and say, hey, we need an additional $3,000 to get this deal done. And I was
Strict.
an idiot in some ways to say, no, I'll go buy the house down the street. It's a little bit less. And now it's like, oh, I wish I would have bought that one too. But you can't live in that world either. You can tell I still go back to it. However, now is it really hard to get a cash on cash return of 18%? Really, really hard. Okay? So now it's possible, like if you were able to buy like a property that's, from maybe your grandma's will or whatever, you might get it cheap enough to make it work that way. But you've got to change with the times and say, okay, what is an acceptable rate of return, cash on cash return for me in this market? Okay? Because I know our affordability is there, I know our trajectory, I know our population is going in the right direction, so I still believe in our market, but I got to be okay with a different cash on cash return. Okay? Any questions on cash return?
What's your acceptable cash on cash return right now in this market?
So for me right now, I won't even look at a property unless it's a 9% cash on cash return. However, and I'll show you today, the majority of properties are running closer to like a 6 to 7% cash on cash return. And I'll actually run through a couple properties that are on the market with you today and show you how to do it. Yeah.
Do you calculate that if you're purchasing land?
The cash on cash return. Generally speaking, unless you're going to rent it to like a goat farmer or for greenbelt uses, a lot of times land doesn't have any income coming back. So really, in most cases, there isn't a cash on cash return on the land.
So an example would be, I have a property that I am working on potentially buying, and it's already been zoned for student housing and multifamily. And so it's just like, I'm trying to run through the numbers on that.
So you're trying to run the numbers on the actual production of the multifamily, right? So you need to run the pro forma based off of what is the intended use of the property, right? So when the sixplex is built, by the time I pay for the construction and however I'm going to leverage it, what is my loan to value ratio going to be? What's my total cash going to be in the property? And based off of real data, what is the return that's going to be coming in off that rental property? And then I can calculate my it becomes a projected cash on cash return. But then the second piece of that is saying, okay, well here's what my asset is going to be in 12 months from now when I'm done. Then the question becomes of, I've got 12 months now of no income coming in on this property. Then I look at it to say, well, what is my strategy in the event the market shifts and I don't get the opportunity to build that, or the city comes back and says you can't build that. If I went out and borrowed hard money at 18% or 12% on that land with the anticipation that it's gonna pay off, is I put myself at risk because there's things outside of my control that are gonna determine whether I can build that property. So I'm really hesitant on a deal like that without doing some kind of protection. So on something like that, I would really look for an opportunity to say, hey, I'm gonna find a landowner that is willing to partner off with me, that they'll still continue to carry it, or they'll subordinate, or they'll make me a loan based on the production of the unit, and we'll split profits on that side or something like that. So sometimes I get creative, because The one deal I did get caught with was land.
It's been approved for 350 units, and I've been going to different developers because it's student housing next to a college. But right now I have the control of the product. So but it's like brand new, and I'm like, all right, let's walk in. Like, whatever I gotta do to figure it out.
Well, number one, I mean, you did the right thing, and we won't go, we'll end this conversation really quickly, because we won't go deep on it, but we can talk more. But one of the things that you did right is, if I've got a big piece of ground like that, where there's a huge up in the flag of like, what am I gonna be able to do with this, and who's gonna be the backing on it, is number one, if you can tie it up and control the property with a long due diligence period, then you're in control, and it's much easier to go after the investors to be like, this is my deal, I control it. Because what I see agents make a mistake all the time is like, oh, there's a great deal here. They go find somebody like, hey, I found a great deal, and they're like, oh yeah. Then they go talk to the landowner and buy it themselves, right? So you need to control the ground. Okay, the last one is effective return on investment. What's the difference between cash on cash return and effective return on investment?
Well, are you factoring all things, appreciation, paying down the mortgage, all that stuff?
Boom, awesome. So there's the cash on cash return actually brings back dollar bills that I could then go down to the candy shop and buy some candy with, right? The effective return on investment is the cash that's coming back that's actually tangible money that I can use, but also it's bringing back with it intangible money at the same time that's going on my net worth statement, right? So for example, if I buy a house worth $100,000 and it goes up by 9%, my net worth went up by $9,000, but I don't get to use that money until I sell the property or refinance, right? So the effective return on investment is going to calculate how much money am I really directly impacting my net worth statement in addition to just the cash portion of it, okay? So the effective return on investment is similar to the CCR, but includes the projected annual increase to value from appreciation. So the effective return on investment is calculated by before tax cash flow plus projected annual appreciation divided by total cash invested, okay? Another piece of this that's also calculated in here is with every mortgage payment, well, almost every mortgage payment you make, a portion of it goes to interest and a portion of it goes to principal, right? So you're in essence, you're increasing your net worth every month by that little piece of it. So that's also calculated into here, but it's generally a smaller piece, but we still calculate it in. So I always look at the effective return on investment too, because if my cash on cash return is showing it at 7%, and my effective return on investment is showing it 22%, are they both real numbers? They're both true numbers. They're both giving me a return. They're just calculating a return differently. Rachel.
So because appreciation is speculation, really, do you consider this in your decision to purchase, or is this just so you can be calculating your net worth?
So I always take it into consideration for my acquisition, but it always makes me ask the question of like, how confident am I in the direction of the market? And that takes me back to my macro conversation to say, okay, for me in Utah, based on our projected population growth, based on our unemployment rate, based on the affordability index, do I anticipate that we're going to continue to get double-digit appreciation? No. Do I anticipate that our market's going to continue to appreciate? Yes. Particularly over the long term, because could next year Donald Trump make some crazy decision?
Yeah.
No, never, not him, right? Could something happen next year that actually could make our market do a little bit of a dip, but it can come back? I'm playing long term. Yes, I do short term investments, but my long term strategy is always, what if I have to hold it long term? Am I safe? Okay, and I'll show you in the software that I actually plug in my projected appreciation, which I'm very conservative on that to say, okay, well, yes, our market increased by another 9% in this county last year, but I might run it at 4 or 6. Okay. Any questions on this? Okay, would you guys be okay if I showed you how to use the software real quick?
Yep. Yes.
Okay, awesome. I'm gonna sit in that chair right there if that's okay.
Oh, yeah, do you want me to?
Nope, you're good.
Then we can just keep them if you want.
Just hit me in the back of the head. Okay, so let me first show you. This is a property for sale right now in Kaysville that I pulled up yesterday to look at. So generally speaking, properties that I like to invest in, am I talking loud enough?
Yes.
Yeah. Okay, good. So things that I really love to invest in are more traditional type homes. So I really like, for me, I'd like to look for things with a 3 or 4 bedroom because they're the most rentable. I like things with a 2-car garage, and I like them to be a little more of like a standard side-by-side garage than like a tandem garage. I like things with some kind of yard. I generally like a very low HOA fee if I can help it, because like in a condo or something like that, if rents are affected, my HOA fee still stays high. And particularly if I have a lot of vacancy in a condo project, my HOA dues are likely to go up. So I'm very hesitant looking at townhome projects or condos for that reason. So I really like to look at houses like this because I'm going to drive a great renter, probably with good income, and have some opportunity for real good appreciation, because single family houses like this are the least affected by swings in the market. Okay?
The least what?
Affected by swings in the market. Okay? How was it the person closest to me didn't hear that?
She was yawning.
Okay, so we're gonna do a quick analyzation on this property. So if you go to, and the way to use this software is, it's not actually a software you download on your computer. It's at savvyinvestor.biz/proforma. And for those of you that signed up on the sheet, I'll send you the link with the slides today, so it's easy to click through. Okay. But if you go to this website, you can really easily just punch in the information to get things rolling. So number one is, you're not going to get blasted with a bunch of emails from me. I own this whole website. The whole purpose that I like to track who's in there is because I just like to track who's really monitoring investments on a regular basis, so I can help where I can. So you have to put in your email. And then you start here with the purchase price. So this property is currently listed at $199,000. It's been on the market for 85 days. What would you, Brandon, what would you offer on this property?
175.
Okay, so let's say we offer 175 and we end up getting it at 185. You think that's fair?
Yep.
My loan to value ratio, James, are you still in here?
No.
Okay, what on a investment property loan programs right now, what percentage?
25.
25 down?
Yep.
So our loan to value ratio is 75%. So if you put that in, it's then going to start the pro forma for you. And then as this comes up, it's really simple. The only boxes you need to fill in are the ones that are blank white. The ones that are gray are auto-populated. So here we know that the purchase price is 185. Is the market value of that house probably around 185? Yep. So we're going to leave those the same. I'll show you in a minute how it changes to do that.
Actually.
It may be a little bit higher, right? Particularly if I go in and say, if I have to drop $7,000 into it right when I do it, the market value is going to immediately go up, right?
Right. I just did this on a house. And
What's the interest rate on an investment property right now?
5. 5 and a quarter.
5.
So let's run it at 5, maybe just under. Let's run it at 4.95.
Look dangerous.
30-year mortgage. Okay, now we look, this is where we get to put in our closing costs, our fix-up costs, any costs that we feel like we're going to have out of pocket right now, okay? So what are my closing costs going to be on a purchase of 185 roughly?
$6,000.
1.75 to 2.
Okay, so let's say $6,000 on the closing cost. Let's say that I've got a couple grand of repairs. I'm not going to do a major remodel on this. I'm just going to get it ready to rent, okay? So let's say we're $8,500 here in our closing costs and our fix-up costs. So now we know our total cash required to close is $54,750, okay? My square footage on this property is 1980. And you can see that the sections here between these blue sections, from blue to blue, is I'm just putting in information, and now I get to look at what my assumptions are. So this goes back to your question, Rachel, of now I have a couple assumptions to make on the property. Now again, don't assume things just to make a deal work. If you force a deal to work, walk away. So here I'm going to look at this and say, and these are the numbers that automatically pop in because these are normally the numbers I run, but you can change these. So anywhere that it's not grayed out, you can change. So real estate appreciation in Davis County last year was 11%. I've got 8% in here now. Do you think it's safe to say we're going to appreciate by 7% next year? Okay. My vacancy rate in that area is
87%. Do you want the 8 there?
87.
Really looks good.
I was just making sure you guys are paying attention. Everyone's awake.
Even though I can't
We'll
hear.
continue to move forward. Vacancy rate's pretty low in that area right now, right? So let's run that at 4%. Management fee. If I'm going to hire a property management company to manage it, this is a property that's going to rent for a little bit more, so I'm going to negotiate a deal on this and probably get 8% on my management fee. Okay. Now this home is a little bit older. so I'd probably push the maintenance percentage up a little bit on this. So we're gonna run this at 4.5% on the maintenance side. Okay, if it's a brand new house, generally I run my maintenance at a very, very low cost because I'll carry home warranty and
2%?
like
Is your home
like
warranty?
2%.
Is your home warranty considered part of that maintenance?
No, that would be part of my closing costs.
Okay.
Is that percentage of market value?
Percentage of
Rental
rents.
income? Okay.
Yep. Gross rent on this. So there's a couple resources to look up rent. Either KSL or the other one that we use a lot is called Rentometer. The nice thing is in Arizona they run all rentals through the MLS. It's really nice because I can pull really solid data. But if you look at Rentometer,
RENTOMATER?
just like this.
Okay.
So this is a property, you just punch in the address and say the size it is, and it automatically pulls all the rental properties and the averages in that area.
Mark, something to consider with people that don't use this, you have 10 free properties that you can pull after that, they'll make it sign up.
And I think it's like $9 a month or something like that.
We just paid $200 for the pro for the year.
Oh, cool.
It used to be $100, and then we just re-upped it at $200, and now we have unlimited.
Awesome.
And then that adds in a few other features as well. So you do have 10 to pull. So if you're not doing tons of this, it's fun to play around.
Yeah, awesome. Great point. Thanks for bringing that up because they cap you at 10. Is that right?
Yeah.
10 a month.
Yeah. So you could I don't know. I think you maybe log on somewhere else. And,
Yeah. It's much cheaper just to buy a new laptop every 30 days. A great point though. KSL is also obviously a great place to go to look at rental properties. You just don't have as good of search functions as this, and this pulls the averages for me. So here I'm looking at the average is 1580, the median is 1700. It shows me a range here. Okay, so based on this, what should we run the rent at?
$1,650.
Okay, let's run it at 1600. That falls in the middle of what I heard yelled out there. So you can see that anytime I fill in a white box, it automatically calculates either the annual or the monthly, depending on how we reverse engineer it. Okay, so here we're going to look at this and say we're going to get 1600 a month. Now, a lot of times I'm like my initial run through this is it worth my time to make an offer on this property? Once I get the property under contract, do you think I'm going to spend a little bit more time on verifying these numbers? Mm-hmm. Yeah, but for the purpose of writing an offer, I'm going to go through this pretty quick and just be like, hey, Rentometer's telling me it's 1600. They're a reliable source. I'm going to put it in, and then I'm actually going to go deeper on my research through my due diligence. Be like, hey, it's probably closer to 1500, or maybe it's closer to 1700. I don't know. Okay. Then I come down here. What's the property tax on this property? Is $1267.
Seriously, that seems low.
It's Utah.
I know, but it
How much does it cost for insurance on a property like this?
50 to 60 a month.
500 a year.
Okay, so 500 a year. There's no HOA, so we'll put 0 in there. Then it auto calculates maintenance based off of the number we put in above. And then I have a column here for other. What kind of things would you put into other? Okay, landscaping. So basically anything that is going to be an ongoing monthly expense for me that I know I'm going to have to incur.
Water, sewer, trash.
So if it's a condo where I'm required for water, sewer, trash, on homes like this, I make the tenant responsible for all landscape, utilities, pool maintenance, anything like that, right? So if I had something though, I could put it in here.
You don't put water? You don't put water included in your rent?
In a condo, if I have to pay the water bill through the HOA, then I include it in the rent. All utilities, I like in the tenant's name.
But they won't let you put certain utilities in the tenant's name, right?
I thought water was a lien against property.
If you have, so in my experience, if you have the cities that have a trouble with it, if you put a letter on file with them, they're fine with it. But
what on file?
Like a letter on file, like a guarantee. But if they don't, then I'll put it in there. Okay. But that's one of the things you'd have to look deeper on, like with the Rentometer, to say, okay, well, does that include all the water prices? And I might have to call a couple of the rental properties and be like, hey, just out of curiosity, I know you rented the house on Main Street. Did that include utilities or did it not? Right. So I'll go a little bit deeper with my due diligence. Yeah.
Would you put vacancy factor in other?
No. So the vacancy is automatically calculated from right here. So I put in my vacancy rate. It's already going to auto calculate or deduct my vacancy down here in our net performance. So here's my expenses. I'm going to move down, and now it's going to give me what my first year estimated net performance is. So here now I'm looking at this saying my net operating income is $1,100. My mortgage payment is $740. If I have to pay mortgage insurance, I'd put it in here. I don't like mortgage insurance. If I'm stretching a deal that much that I've got to get mortgage insurance on the deal, it's probably not the right deal for me. Okay. So but I built this place you could put into it. So now I can look at it and say my before tax cash flow is already calculated at 488. This much money every year is going to go down on principal, and in my first year I'm going to spend $1,000 on appreciation. I'm going to get appreciation of $1,000 a month, $12,000 a year. So now, do you recognize these terms? Those are the ones we talked about. Yep.
172 a month or a year?
172 a month. Sorry, did I say a year?
Yeah, that's fine.
Cheryl's awake, everybody. She's paying attention. Okay, so then I go down here. You're right. So this side's month, this side's year. So now I go down and I want to look at my financial indicators. This is where I can tell really quickly, is this worth me making an offer on this property? So my debt coverage ratio is 1.61. Good or bad?
Good.
Great. My annual gross rent multiplier. Okay, is this the primary property that this would have the biggest impact for me to track this number? No, because I generally use that on multifamily, but it's still interesting for me to look at and say, hey, if I took 100% of the rents in, it would take me 9 years to pay this off 100%. Okay. Cap rate. Okay, is that a good cap rate?
Yes.
It's a great cap rate in this market. Okay, cash on cash return. Does that hit my standard of 9?
Yes.
And then my effective return on investments. How many people here would like to get 37% return on your money? So there's some opportunity here, right? That's how simple it is. Does that mean I'm going to get it for 185? No. But would I write an offer on this? Did I try to write an offer on it last night? Yes. It went under contract last night. Not with me.
When you're talking about your effective return on investment, how long is that holding the property? I mean, because that matters, right?
It does matter, yep. So this is based on averages. So the thing is to keep in mind with the 37% is it's not guaranteed.
Right.
It's purely based off my speculation of the market. And so the more conservative I am with my speculation, so it's like, for example, if I go up here and be like, man, let's change this to say the appreciation is going to be 4% with our because I'm nervous about where our market's going to top out. Let's put that at 4%. Let's also say that rentals are going to get a little bit more competitive, so we're going to run that at 8%. And now that I've gone into the property, I know there's more maintenance that's going to be done. I'm not going to do anything now, but I'm going to actually increase this to 8% with some anticipated things coming up. Okay. So then I can go down and we'll automatically update the numbers, and I come down here and look at the numbers and say, oh, well, now my cash on cash return dropped to 7%, but my effective return on investment is still 24%. So now I can look at it and say, okay, well, now am I still ready to move forward with the property, now that I've learned more about it?
Would you, based on those numbers?
Would anyone guess how I'd answer that question?
Doesn't meet your 9.
It doesn't meet your 9.
Okay, does it meet all my rules? And the second thing that I don't really know yet, because I haven't physically been in this property, is for an older property like this, what if it's on a street where all the other houses have been renovated and are like up to date and super sharp and selling at high rates? Would I be okay to go buy this for a couple years and rent it out and then look at renovating it and selling it at a big, I would look at that, right? So I'm always asking the question, why? Okay, well, I like the property, but why is it now 7%? Would I move forward at 7%? So I run through this a couple times. The first time is that big initial swipe of, should I tie this up? Second one is, okay, now I control the property. Let me do some research, and then we really compare this to my rules and get it closer to reality. So I'm doing a really broad brush stroke, and then I'm narrowing it down to finer brush strokes, ready to move forward.
So where do you want your cash on cash? What's your magic number?
For me, I like my cash on cash return at least a 9%.
Oh,
I think it's acceptable in this market to be looking at probably above a 7. I'm more, because I'm more aggressive.
Cash on cash return.
Because I'm aggressive with some of my money right now. I want
so
higher.
9 or greater.
Correct.
Okay.
Yeah. Is this easy to use? Better than a lot of those crazy ones out there, right?
Yeah.
Thanks, I built it. The other thing that I made it do is that if you go in here and you can print directly from it to a PDF, so that if you're working with an investor client and you know what their rules are, instead of just sending them the MLS sheet, you can send over this pro forma with it, and then you can educate them directly off this. Yes.
Do you have to have this online, or do you have another format?
This one's all on, you have to have access to online for it. I built it originally just on an Excel spreadsheet. The problem was, is I started giving it out. People that don't use spreadsheets all the time were messing with my formulas, and it ticked me off. So I built it this way, just on the backside of a website. Yeah.
So I've used this before, but then when I go to convert it into a PDF, like it just deletes a bunch of the boxes. Is that because of my browser, or is that?
It may be because your browser, but then when you go to the print and you say convert to a save as a PDF, sometimes you got to make sure that it shows like a 1-to-1 ratio depending on your computer, like one tall, one two tall, one wide, because sometimes we'll try to loop part of it onto the next.
Because did it change the form, like it just messed the whole thing up?
I actually programmed it to only do that for you.
Wow, you're special.
I call it the Carolyn factor. If you want me to look at your computer, I can look at it. But it's probably just messing with it to say fit
It does
the
it
fit
on
ratio.
both my PC and my Mac.
Yeah, because it doesn't matter computer. It's Carolyn
me,
factor.
okay.
Yeah. Any questions on this?
You're gonna tell us how to get it, right?
Calculator and the affordability index, is that automatically linked?
The affordability index. Oh, for my other tabs. So here with investor, this is just another one of my companies that's just purely informational. So if you go to like the home tab, I post things on here once in a while. What's going on in the market? Affordability index. I have it linked so it calculates in here. It's not pulling up right now. It's trying to transfer the data. And then home profit calculator is for me to drive leads off this too. If someone came in and wanted to calculate the lead of the profit of their house, they could click through here. I don't recommend. Oh, that's actually would be interesting too. This is one of our campaigns we run it's called the Move Up campaign, of helping people learn that sometimes the best way to get into real estate investment for people is to buy a 3-bedroom, 2-bathroom house, move into it for a couple years, fix it up, and build the equity in it, and turn that property into a rental and move into the next one. Just if they can get in a consistent pattern of doing that, it's a great way to build wealth. So this is a video we put together on how to do that. As far as keeping track of the affordability index and what's going on, obviously the quarterly market update, I do that quarterly to keep people abreast of that, but you can also Google search it really easily. So let me show you a couple more things for us to wrap this up, then we'll open it up for questions. Can I squeeze by you again?
Of course you can.
Thank you.
Oh my gosh.
So a couple other things to consider here is with this is you got to have an investment team in place. As real estate agents, we can be the expert in real estate, but we've got to be careful that we never cross lines in giving advice on things we should not be giving advice on, which the two primary ones are legal advice and tax advice, right? Yeah. So we want to make sure that if we're going to be serious investors and active investors, both for ourselves and for agents, we should put together our investment team. So obviously number one is having a phenomenal real estate agent, which there seems to be a couple in this room. Number two is lender. Like you can be working with a lender that is phenomenal with traditional resale, but just does not understand the investment game. So the whole conversation that we talked about, remember those vocabulary lists? My full anticipation is that my lender better have the ability to talk that same language, because you know when I told you at the very, very beginning of the meeting, within 5 minutes you can totally discredit yourself as an investor and talk to an investor? If you go through the whole process of building the relationship and then you hand them off to someone on your team and they can't have that same level of conversation, it not only discredits them, but it discredits you. So make sure that you have people on your team that can talk the language. A great real estate attorney. If you don't already have a relationship with an attorney, I'm happy to get you in contact with mine. One of the things that I always get the attorneys involved in is specifically how to vest your property. What does that mean, how to vest your property? How are we taking title, right? So I will precurse this to say that I am not an attorney and I am not an accountant, but this is how I do vest my properties. Is I have one company that is my main investing company called Green Holdings. And then Green Holdings then becomes partners in other entities, and I try to limit every single one of my investments to one entity. Every once in a while, if I buy because there's been several occasions where I bought 2 or 3 houses on the same street, Sometimes I'll group them into the same entity, but I try never to do more than a couple properties into the same entity. If I have different partners in a project, I always have a specific entity for that project. Even though I'm very careful about who I partner with and invest with, if things went wrong or something went wrong with their estate, I want to make sure that my exposure is limited just to that entity, okay? So if you don't have an attorney to help you put together investing and articles of organization and operating agreements, be sure to get one and build a relationship with them.
You know, my brother did that. He went in business with a guy. The guy got a divorce, even though it wasn't technically, everything was both theirs, because it was in one LLC. He ended up paying all of that money to the other guy. I mean, he lost a lot because of the other guy's divorce.
Yeah,
So-
it's really important to understand how to protect yourself here.
And is Green Holdings an LLC?
Yeah, so Green Holdings is an LLC. The majority of my holding companies are LLCs. Then I for like more of my active business income, I run them through S corps. But specific with my holding companies,
So
they're
like
LLCs.
Properties, so like properties, whether they're rentals or flips, whatever.
Yeah.
It's another LLC that has a partnership agreement with Green Holdings. It's another LLC.
Exactly, yeah. So Green Holdings is who owns the partnership in the other LLCs.
And why would you have more than one holding company? You said you had a few holding companies, so you have one for like flips, one for rentals.
Different,
or-
yeah, so it depends on state lines too, where I'm investing and which, I mean, almost everything, I'm trying to think if I have everything. I have a couple that I've kind of went around Green Holdings and went directly, like me personally owning it. But the majority, almost every single thing I own right now is Green Holdings owns the interest in the other entity. And the reason I like that is because then I have another layer of expenses too. So say like, and I know it's not super creative, but say MBG 22 LLC is having a profit, who then pays out my portion of the profits then to Green Holdings. Now Green Holdings has a layer of expenses and write-offs that they need to do before it's released to me.
Personally, yeah. So have you heard of series LLCs? I just heard of that just recently, listening to the podcast, and that's what they're saying. That's kind of a new way to do it. You can do a series LLC, which is like some people create it for like children, things like that, where you have one LLC and then you have series A, B, C, and they said you could just basically open up all the series, you know, underneath that first company, and they say you can just have a template that you could just, if you need to shut one down, you wind it down, then just open up a brand new one. But then they pay from those series, they pay all the contractors, they do all the stuff, so it's not tied to the original one.
Yep.
So you know,
And they
for
do
liability.
that, investors do that too, too, underneath one just for each individual project, like you.
Yeah. Because the key for me though, and I'm interested to look into it, because it sounds like almost the same way I've structured it, just under a different name, is making sure that I can clearly show in the event of a lawsuit against one property that they're only tied by name, that the liability does not cross from one to the other.
And that's what this is, that's what he was saying, this is kind of the new way to do this from what people have done before, creating multiple LLCs. This is the new way, cheaper, better.
Will you email me the link to the podcast?
I'll talk, yeah.
Awesome, I'd love to listen to it. Cheryl?
If you purchase the property cash because you had to fix it up and it was not loanable, and you bought it in an LLC.
Yep.
And then you wanted to get a loan on it to pull that equity out, can you do that, or do you have to put it in your name?
You can get the loan in the name of the LLC, but you may have to personally guarantee it depending on where you're going for the financing and how it's structured. Yep, so there is opportunity to do that. So invest your property, make sure you got a great accountant that understands your objection and what you're trying to get done. And then I recommend using a property manager, because there's, particularly because the landlord-tenant disputes are way on the rise. Landlords are professionals out there that know how to take advantage of the system. So I always recommend using a property management company that, number one, like for me, it's important that the property management company, the owner of that company, is also an investor, so he speaks the investor language and knows how to protect the asset. And it's just another way to reduce your risk. It does cost money, but in my opinion, that $80 a month or $85 a month is not worth your time of what you can go make money chasing another deal. Okay. So don't wait to buy real estate. Buy real estate and wait. I'm a very big believer, and even though there's opportunity for quick return on some flips, because I'm a very big believer in buying things that you're going to hold for long term. And then the last thing I'll say, talk about real quick, and then I'll open it up for questions, is if you're serious about being a real estate investor, personally, and also, and I think it goes hand in hand, and not only being a real estate investor, but helping more people with their investment strategies, is you need to make sure that you're letting people know that that is a world that you want to work in and that you're an expert in that area. So you need to have some marketing pieces put together of how you're going to attract those conversations so that you can put your expertise on display with them. Because again, even though, say, Joe Schmo decides he wants to buy a rental property, he may call his regular real estate agent who helped him move into his house, but he's gonna learn very quickly that while that person was phenomenal on helping them move into their house, they don't understand real estate investments. And then they're gonna ask the question of like, well, who should I be talking to? So if you don't have, if you're not targeting investors as part of your campaign and giving them valuable information, you're gonna miss the boat. So, this is one of the pieces that we use, I gave it as an example of a way to capture some information. So obviously, the majority of investors or people that want to invest today are getting into it because of HGTV and things like that, or hearing about the opportunity. That you need some kind of catchy article that has value that's going to cause them to be like, hey, this is something I need to know. So this is an article we wrote called "The 3 Most Common Mistakes Real Estate Investors Are Making." We actually just shifted this. My team has the updated one. I don't have the updated one. But we actually shifted it to say in today's market because I wanted them to feel like it was relevant to now. So the 3 most common mistakes real estate investors are making in today's market, and they really stay very similar. But number 1 is not staying up to date on the market. Number 2 is hiring the wrong property management company or trying to self-manage. And number 3 is not vesting the property appropriately. And the whole purpose of this is for them to say, I want that information, send it to them, and then give you an opportunity to have a conversation where you can put your expertise on display, ask them the questions, find out what they're looking for, what their rules are. And sometimes their answer is going to be like, I don't know what my rules are or what the expectations are. But sometimes that's the best answer because now they're saying, oh, I don't know, but you do know. Will you help me figure that out? And the more value you can provide for that conversation, you'll build a great client. And the thing I love about these type of clients is if you do a great job, it's not them buying a property every 3 to 7 to 9 years like a normal client. They're consistently buying properties. Okay? So we'll come up with something along the line. I'll include this in the slides I sent out so you can read through it and pattern it after that if you want. This is my contact information. There's the link I'll send out by email. Make sure you sign in, and then I'll open it up for any questions that anyone has. Was this helpful?
Yes.
Awesome.
You're gonna send out the slides too?
To everyone but you. Absolutely. I'll send you the slides. Make sure to sign in. Yes.
Do you know much about self-directing a 401k to
Great
buy an
question.
investment property?
I do. So I have a self-directed IRA that I use. And I think there's some great opportunity there. I mean, there's extra hoops you have to jump through to use it. But the beautiful thing about it is 100% of the income goes right back into the IRA and usable. And generally speaking, even though there's some extra hoops to go through to access the money and some extra forms to fill out, it's really not that hard to do once you're with the company. So the company I use is called Equity Trust. And the nice thing about it is you can do not only real estate, but you can do a lot of different things out of it. But if you go to Equity Trust, they've got like videos and stuff on there to how to set it up. But it's almost the exact same thing. The key there is making sure that you're writing the contract right, because you just got to make sure that all the checks, everything are written exactly correctly to the IRA and not to you personally. Because if you ever show that the funds hit your personal account instead of the IRA account, that's when you're in trouble. Joe.
Are you actually buying in that, or are you just lending out of that? Because I know some people they say, yeah, I don't really want to hold it in the IRA because of liability. I'd rather just like do notes out of it.
I mainly out of my self-directed IRA, I do hard money lending almost exclusively. So my money's out in pieces like 30, 60, 90 days max on there, and that's where I'm doing kind of like for example, I just made a loan on a guy that was shipping in a whole ship full of Christmas gadgets that he wanted to sell on Amazon for Christmas, and while the boat was on the way over here, his funding fell out. So he was in a panic because he had to sell it all before Christmas, and so I was able to capitalize on that where I loaned him some money against that inventory. So I do some stuff like that as well. What other questions do you guys have?
Marcus?
Yes.
So you said the time block, like learning this all the
great question. Thanks for bringing that up. So here's one of the things I would recommend is I've used the analogy a couple times, the needle in the haystack, is you can understand this, but what it doesn't do you any good of is leave this class in 3 months from now, have an investor say, hey, what do you think about this property? You go into the pro forma analysis and you run it. Like, you'll look at the numbers and see what the numbers say, but you really don't know if it's a great deal compared to everything else in that area because you're not running enough of them, right? So the key here is if this is something you want to get good at, I would recommend saying, hey, once or twice a week, I'm going to pick 3 or 4 properties off of the MLS, and I'm just going to run them through, regardless of whether I'm working with an investor, regardless whether I have money to invest or not. I'm just going to consistently run 10 to 20 properties a week through this software, because what you'll do is you'll be like, yep, wait a second, what? This could be a good deal. And then if you find a good enough deal and you're motivated enough, then it's much easier to get on the phone with everybody in your database and be like, hey, I'm just calling to follow up. Do you have any need for an investment property right now? I analyze 20 to 30 specific properties a week to find great deals. And out of the last 100, I found one that's a phenomenal good deal. Would you be interested in partnering with me on it? Right? It changes the conversation other than like, I think it's a good deal. So I would say time block for it, run it through, pick your targeted areas of where you want to invest, and just start running through the pro forma over and over and over again. Okay? What other questions do you have? When there's no questions, it makes me think one of two things. I crushed it. Or 2, everyone's like, get me out of here. So I'm gonna go with number 1.
Actually,
both.
It's hot in here.
Yeah, try wearing a jacket and an extra 20 pounds.
You recommend a good book that kind of goes along with this?
So a couple of the books that I really like is, number 1 is The Millionaire Real Estate Investor. So it's based off the MRA model, but it's the blue book. So I highly recommend you reading that. The other one that is good is Hold, that talks about how to buy properties with the intention of holding them. The hard thing with like specific investment books, in my opinion, is generally by the time they hit the bookshelves, they're antiquated strategies. Okay, so the nice thing about the Millionaire Real Estate Investor is it's purely about a model and not necessarily saying, hey, here's what's going on in the market today. So the key with that is be an expert in the market, spend time going to, looking for specific investment properties in the MLS, potentially go join the local real estate investment clubs where you can go have conversations with other people that are looking at properties. The one caveat I would give with that right now is always in a market where there's a lot of money to be had, there's a handful of people that decide to make a bunch of money off of trying to convince other people how to invest and not necessarily investing. So really look at track record. If you're gonna team up with someone or go to a seminar or talk to somebody that's doing investing and saying, hey, give me your money and I'll go guarantee you these deals, really check track record, because the majority of those guys have learned like it's in the time of the gold rush, right? Who made the most money? The guys selling the shovels, right? There's a lot of that going on in our market, both on the investment side and also in the real estate coaching industry, in my opinion. There's some coaches that are absolutely phenomenal and worth every penny they get paid. And there's some of them that decided, hey, I can't sell real estate, but I'm dynamic, so I'm gonna go be a coach.
So you did the Millionaire Real Estate book, and then you did a shift. Are you gonna do Millionaire Real Estate Investment? The book for that?
I'd be open to that.
Okay.
How many people are plugging into and listening to my weekly webinars that I'm doing? Handful of you. Okay. Sometimes. Thanks for being there sometimes. Yes?
Tell us more about these.
Oh, the webinars? So every Monday morning from 8 to 8:30, I do a webinar. So it's all virtual. And right now we're covering the book Shift. So we're talking about specific strategies on how to capitalize in our market right now. And if you missed any of them, I record every single one of them, so that if you sign up on the Eventbrite page, you'll get emailed the link every single week. And it has both the audio from the conversation if you want to listen to it while you're driving, and it also has the video if you can stand to look at me for half an hour every single week. So you can choose the audio or the video.
Is that the one that's through Zoom?
Yes.
Yeah. I don't have to speak to you. I cannot, for some reason, Zoom, I've done everything that
Oh, no.
and they will not, I can't.
Are you on Carolyn's computer?
It's the weirdest thing, so I missed the one because I couldn't get into
Try to uninstall it and reinstall Zoom. But if you want, I've also at savvyagent.biz/shift. All of them are there and recorded. So if you don't want the emails, you can just every week go to that link and click it and watch and download them there. And you don't need Zoom to rewatch them. And then for any of you that are right now reading The Millionaire Real Estate Agent, it's savvyagent.biz/MREA. And the whole book for The Millionaire Real Estate Agent is broken down into 30-minute sections as well, with me talking about that. And it gives you the reading assignments and talks about that section. Yeah.
Wait, what was the first one, savvyagent.biz/?
Shift. So Shift is the one we have going on right now. And the MREA is the one we finished at the end of 2017.
savvyagent.biz/MREA.
Oh, MREA.
Well, I wanna send that to Capital Recruit.
Oh, yeah. The little one? Okay, any other questions for me? Okay, then we're gonna wrap up. I applaud you guys for taking some time out of your business, because I know the iron is hot right now for you guys to be out striking and create more business. I think there's a ton of value in this market to really capitalize on our active income as real estate agents, but it's also a great opportunity for us to look for investment strategies, build opportunities, particularly for those people that want to be investing that don't know how. There's a great opportunity for us to really increase our personal return on investment by partnering on those properties as well. And then I'm obviously available for questions if anyone has them. Thank you guys for being here.
Where's the
Sign-in sheet. Where did it end up? Somewhere. Oh, Eric's got it.
Okay.
Oh, you were there too?
I don't want to keep you guys. If you want to go by, be my guest.
Yeah.
That's right.
Hey, how are you, stranger?
That's what she, I know, that's what she did.
Next week.
So Texas right now
There you guys go.
number one.
I know, I wasn't sure if it's
Affordability just on the increase in however, all of the stuff that happened with the floods and everything last year, there's a lot of problems to homes down there. So the prices.
I was getting ready to walk out because I was getting.
I like Texas as an opportunity. I don't know. However, Twist City is not.
Yeah, no.
Okay, so let me get a I would say if you bought a property here and moved to Texas, would you rent there or would you buy there?
How's it going?
Oh, really? No, buy both.
Yeah, like.
I'm Sean, I'm in the office.
Not necessarily. So a lot of times when you buy FHA, they'll say that you need to live in the house for a specific amount of time unless circumstances make you move.